Hello and welcome to Mint. This is Malvika Joshi. In this edition of From the Newsroom, we are joined by Joel Rebello. Hi Joel, welcome to the show.
Thank you.
The government may have decided to restructure loans given out to the ailing power sector to ease out infrastructural bottlenecks. But according to rating agency S&P, which downgraded India's outlook from stable to negative early this year, says that restructuring will be a quick fix solution and will not ease out the downward pressure on India's sovereign rating. So, hi Joel, tell us what is the rationale behind S&P's statement? Why are they saying that it will be a quick fix solution?
Just let me get back to you to what is the issue with the power sector today.
Yeah.
Most of India's power distributed to state electricity boards, which are managed by state governments. What has happened is these electricity boards have not raised tariffs or have taken huge debts and are facing a lot of losses. What the government has now decided is that they would probably give them more time to pay debt, which is actually restructuring. Right. So S&P has come out with this report today which says that restructuring will actually not solve the problem. It will probably delay it for the time being. It will not solve the problem going ahead, because what will solve the problem is first if they increase tariffs, if they allow them to increase tariffs and to charge from the customers, and to reduce losses by getting in more private players, increasing competition in the sector. These are the two main points that they have said.
Right. So if we were to say that what is the total exposure that banks have to the power sector and how much has the government actually decided to restructure for power distribution companies, if you could give us some...
There is no clear number as to how much has been decided to restructure. Some estimates by S&P itself has said 60,000 crores has already been restructured. Out of total 45 trillion rupees, that's 45 lakh crores outstanding loans, about 11% or about 33,000 odd crores is to the power sector. Not of all of it would be to state electricity boards, but a chunk of it must be to state electricity boards. So that's the exposure we're talking about.
So we saw that India's outlook was reduced from stable to negative. So do you think that despite all this restructuring initiative that the government is taking, the risk of downgrading still remains?
India's outlook was revised to negative from stable was mainly due to the macro factors, high fiscal deficit, raising inflation, policy inaction. Those still continue. Restructuring is just a part of it. What will happen, S&P says, is because of this restructuring, and if this continues, delaying the problem as such, this could weigh on the India's rating and could possibly, be one of the factors that could lead to a downgrade later on. Okay. Right now, a downgrade is not envisaged very soon, but the empirical evidence shows that once a country is shifted from stable to negative, a downgrade follows about a year later. So the rating change from stable to negative happened in April, so we could expect, because nothing has changed, deficit still exists, the policy inaction, so-called inaction, is still there, so nothing has changed as such, so we are still at a risk of a downgrade.
Right. Thanks, Joel.
Thank you.
Will the government pay heed to S&P's statement? Will it really take strong steps to resolve the issues that haunt the power sector is yet to be seen. For more updates, log on to livemint.com.